Hey everyone, and welcome. Today, we're jumping right into a question that almost every investor has asked at some point. Why can't I just buy one single share of any stock I want? The answer, it turns out, is a fundamental market rule that can actually leave you stuck with shares you can't even sell. So let's break it all down.
So imagine this. You've got some money saved up, you've done your research, you've picked a company you believe in, and you're ready to go. But wait, can you actually buy just one share? You might be surprised that the answer is often no, and understanding why is absolutely key to trading effectively. The whole reason comes down to two little words: market lot. The easiest way to think about it is like buying eggs. You can't just walk into a store and buy one single egg. You have to buy a carton, right? A bundle of 6 or 12. Well, the stock market works in a very similar way for many companies. You have to buy shares in these preset, standardized bundles or lots. Now, this whole system of trading in lots, it all happens in a place called the regular market. You should think of this as the main stage, the big leagues. It's the primary arena where the vast, vast majority of stock trading goes down. But here's where it gets kind of interesting. The lot size isn't just one fixed number for everything. It actually changes depending on how much a single share costs. So for a lower price stock, let's say one under 100 rupees, a single lot could be a whopping 500 shares. But as that share price goes up, the lot size shrinks. The market authorities do this to keep the value of one lot pretty consistent and make sure trading stays orderly. So you might be asking, okay, but how important is this regular market really? Well, get this. About 99% of all stock trading volume happens right here. So yeah, understanding its rules isn't just helpful, it's pretty much essential if you're serious about investing. Now look, these specific lot sizes, they can change over time. So please don't get bogged down trying to memorize the exact numbers on the screen. That's not the point. The crucial thing is to really understand the concept. The source material I'm drawing from puts it perfectly. It's like learning to drive. Once you have the skill, you can handle any car. Same idea here. Once you get the concept of a market lot, you can navigate any changes they throw at you. To really see how this works and where it can go wrong, let's make this real. We're going to walk through a super common scenario that shows exactly what kind of problem these lot sizes can create for an everyday investor. So let's meet our guy Abbas. He's an investor just like any of us, and he's about to run headfirst into the exact issue we've been talking about. Abbas owns exactly 100 shares in a company. Now, based on the price of his stock, that 100 shares is one perfect full market lot. So far, so good, right? He can sell this on the regular market anytime he wants, no problem. But then, his company does something pretty cool for its shareholders. They announce a 37% bonus share issue. This basically means for every 100 shares you hold, the company is going to give you 37 new shares completely free. And just like that, 37 brand new shares land right in Abbas's account. His total is now 137 shares. But this is where his problem begins. Abbas decides, hey, this is great, I'm going to cash in on this bonus and sell those 37 shares. But when he tries, he hits a brick wall. Why? Because 37 shares is not a full lot of 100, so he can't sell them on the regular market. And he can't sell his full 137 shares either, because that's not a perfect multiple of 100. He is, for all intents and purposes, stuck. So what happens now? Are those 37 shares just trapped in his account forever? Is there just no way for him to get their value back out? Well, this is precisely why the stock exchange created a workaround. There is a solution, and it's called the odd lot market, and it's designed for exactly this kind of situation. The odd lot market is basically a special side market that runs right alongside the main one. Its one and only job is to handle these odd leftover shares, any amount that is less than a full standard lot. Let's put it this way. The regular market is the main superhighway. It's built for tons of traffic, but you have to be in a full lot. The odd lot market, that's the special access ramp, built specifically to help investors like Abbas deal with those leftover shares and get unstuck. So now that Abbas knows about the odd lot market, he's not stuck anymore. All of a sudden, he has a strategy. In fact, he has two very clear paths he can take. His first option is simple. He can go straight to the odd lot market and just sell those 37 bonus shares. Problem solved. His second option is a little more strategic. He can use the odd lot market to buy 63 more shares, which would round up his total holdings. Now, why would he do that?
because buying those 63 shares magically transforms his 37-odd shares into a brand new, complete lot of 100. He would then hold 2 full lots, and he can take that new lot and sell it on the much bigger, much more active regular market. The key takeaway here is that the odd lot market is a tool you can use to get back into the main arena.
So we've seen the problem of being stuck with odd shares, and we've seen the tool that was designed to solve it. The odd lot market gives investors flexibility where the main market can't, and that brings us to the final decision. So I'll turn it over to you. If you were a boss, what would you do? Would you sell the 37 shares for a quick gain, or would you buy 63 more to build up another full lot for the main market? There's no single right answer, and your choice says a lot about your own personal investment strategy.